Hey guys, welcome back. In today's video, we are looking at the lawsuit dismissed, shorts going to zero, naked shorts being investigated, and many more in this video. Now, for those of you who were aware, yesterday Roaring Kitty was sued for securities fraud for using tweets to promote GME. And if you want to take a look at the summary, essentially what they're saying is manipulating market sentiment, profiting from inflated prices, violations of federal securities laws. So this is a quick rundown, but what later on was found out was that the person who was suing Roaring Kitty only held approximately 35 shares, and the cost basis was likely under $1,000. And what we learned from more is that the person spent more in filing fees than lost money on the momentum movement. So it obviously costed them more money for them to actually file the lawsuit against Roaring Kitty than they did from the investment itself. So from that, what we knew was that obviously it was very likely that this person was working for a short and that they was trying to sue Roaring Kitty just for the sake of it, and it wasn't for their own intentions whatsoever. And you can see that all of this happened during market hours. A lot of you would have seen the news during market hours and could have potentially affected your investments in GME, because lately, right after the market ended, just in, Roaring Kitty security fraud GameStop lawsuit dismissed. So quickly after, as the market ended, the lawsuit was actually dismissed. And so you can see how the things that would have affected the adjustment, the things that would have affected the investment, all happened during market hours, whether it's from when we first learned of the lawsuit, when it's from learn the summary, when we learn in terms of the cost basis. All of these things would have been during the actual market hours when you had your ability to trade your stocks, whether it is to sell your stock or to buy more stock. This would have affected your actual investments. Most likely is that the whole point of the lawsuit was to get you to be scared off of GME and get you to sell your GME shares. And so right after, as the market ends, as no one have that ability anymore, obviously not accounting for after hours, the lawsuit was dismissed. So we can see that this was just a distraction. This was just a quick play made by these shorts, as always, to try, whether it's to disgust, whether it's to confuse everyone, but at the end of the day, it was used to make people to try and sell their shares of GME, most likely. And from everything we've deducted, it's again just another ploy used by these shorts. And so this was a quick rundown, but if you take a look at some other things, and again, this is with AMC now, and I think it's understanding that short is going to zero, and it's also understanding why they're making these lawsuits, because like we've known, GME can affect AMC as well, and the vice versa. So this 100%, AMC has less debt and monthly revenues increasing, yet the share price is a fraction of its previous amount. This only makes sense due to massive amounts of short seller manipulation. What gets artificially pushed down will eventually rise again. Hold for it. Now, it's in a reply to saying, AMC was 93.57 in September 2018, pre-reverse split. Debt was around 5 billion and revenue was 1.2. Looks like we should be back to 800 today after reverse split with a good future and less debt. Maybe I can do more research. Now, this was also due to something that we covered in one of our previous videos as well, which again, for those of you who watch, would have known in terms of the price targets that hedge funds gave for AMC back in 2017 before they piled billions of synthetic shorts on AMC. Now, what we can understand is that essentially right now for AMC, we are in a better place than we ever have been, especially in comparison to where we were in 2018. And back then, AMC was 93.57. Right now, we have less debt. We're obviously increasing on our revenue. What's more to understand is that our revenue streams have increased from now than when it was back in 2018. Again, one of the biggest factor, and I'm sure everyone will also agree to this as well, is understanding that the investor base for AMC has changed drastically from 2018 till now. There may have been people who have bought into AMC back in 2018, but I know for sure that there are a lot more new investors who came into AMC probably around the 2021 time. Now, comment down below when you guys first bought in your AMC shares. How long have you guys been a shareholder? Like I said, there will be shareholders who've been here for a very long time, but there will also likely be a lot more who came in here due to 2021. And this is the difference between now and back in 2018. The investor base is even stronger. And that is always the best thing a company could ask for, which is a foundation, which is an investor base that is willing to stick with them, that is willing to ride through the storm with them. And that's exactly what we are doing. And so understand is that what gets artificially pushed down will eventually rise again. And this is very likely the case for AMC. Now, furthermore, it's looking at how shorts are going to zero. So, according to Federal Reserve, the total long exposure of financial derivatives for hedge funds, for example, has remained largely unchanged since being tracked in 2012. There was a large spike between 2017 and 2018, but as the total derivatives market size increased, the notional value slowly approached zero. Hedge funds have a total long exposure of 1 trillion. So essentially, we're taking a look at what their long exposure is. Now, the reason why this is important is essentially understanding that this means their correlation with their collaterals. What we have seen is understanding that the long exposure is obviously something they use also as a way of collateral with their short positions. And that again is mostly in AMC and GME. Now, if we know that their long exposure right now is at 1 trillion and that the notional value slowly approaching zero, what we can understand is how the collaterals is obviously fading away. Now, especially with understanding what is to happen recently. What we've seen right now are multiple banks, multiple markets are saying that the market is likely to have a 30% pullback. And now this is obviously just an estimate. It could obviously go way higher than this. And what we've known is with how banks have to cover positions, this obviously could make the pullback even bigger. So it's very likely that right now we are going to be seeing one of the biggest crashes yet to come for the market. Now, obviously, if this happens, and from what we know with how they use their long exposure, very likely we're going to be seeing these short hedge funds go to zero, and with the collaterals also going to zero, they will have no other alternatives other than either to sell all their positions to cover the collaterals, whether that is all the long exposures, or to actually sell their short positions so that they can continue holding on to the long exposure, which is obviously more likely to be the case. And so that's what we are witnessing. Now, furthermore, to understand in terms of understanding how the shorts going to zero and how we're seeing them already going to zero and seeing them have a weakening in their capital, we can see here. So NYSE order imbalance. So for yesterday, we had another buy order imbalance for AMC on the buy side. Now, to reflect that, what we saw was AMC actually going up 1.2%. Now, this is still obviously a very small percentage, but what we've seen right now is recently, especially the past few days, when we do see buy-side imbalance, the typical movement we should see is obviously for AMC to be going up. And that's exactly what we are seeing right now. And so with this, it is very likely that what we are seeing is that shorts are weakening with their capital, with their liquidity, and with their manipulation power. And that's why when we do see buy-side imbalance, we are actually seeing AMC go up. Now, understand that normally, like I said, with a buy-side imbalance, you are supposed to see the stock going up. But with AMC, we know that it's been multiple times when we see buy-side imbalance, but because of the suppression, because of the manipulation, we actually see the stock go down as opposed to going up. So the fact we're finally seeing AMC going up, very likely is showing that the shorts are seeing a weakening in how much capital and liquidity they have right now and how much they can dispose to manipulate AMC. Furthermore, what we can see is right now, for example, a recent BIS article highlighted the growing trillions in missing debt created by certain derivatives, forex swaps, forwards, and currency swaps create debt that don't appear on balance sheets and most debt statistics. So what we're seeing right now is, again, the hidden debt that they have, and this is what we're seeing. And this is very important because we've talked about, in terms of the swaps, we talked about the massive hundreds of trillions of swaps that these banks have obviously exposure to. But what's more important is the missing debt. Now, the missing debt can also know as the hidden debt because these are debts that don't appear on balance sheets and most debt statistics. So with what we've seen right now, with how everyone's already being scared that they're seeing the hundreds of trillions of debt for these banks, which will carry on to these hedge funds as well, is that beneath it all, there is also the hidden debt that we don't know that exists. So these could also mean that there are tens, if not hundreds of trillions as well within these hidden debts. And this is why we know that the shorts are in a very, very bad place. And that's why you can see here, question 1. Can you guess which 9 global banks South Korean regulators are investigating for rampant naked short selling? Question 2. What are the odds they're doing the same thing in the US market? Now, essentially, these global banks are probably the most active in the US market. And so if they're willing to naked short in a market not as big as the US, then it's very likely that they are also naked shorting in a market like the US market. And what we have to see and what we have to know is that when the regulations come for these banks in the US market, they obviously are screwed. This is exactly what we talked about in terms of everything that we just mentioned, with whether it's the debt, whether right now it's with the loan exposure. All of these things will obviously take over. And you guys, thanks for watching. I'll catch you guys next time.